Hi everyone, Cullen here from Legal Home Loans,
Andrew here from Legal Home Loans.
and it's great to be here for the Happy Lawyer seminar on wellbeing, more specifically financial wellbeing.
Thanks, Cullen.
No, absolutely, no. It's obviously it encapsulates financial wellbeing is very important for people's mindset. Although you might not think it, day to day as you're going into your role, it's always at the back of your mind if you don't have it all sorted.
Yeah.
And we went to the Law Society burnout talk the other day, and that was a big focus. The fact that because you as legal professionals are in your work day to day, so busy, billable hours with your clients, that all the life admin things, including finance, get left by the wayside.
They do. We see that time and time again with our clients, actually, when typically we'll spend a lot of time actually fixing up scenarios and, through a very short amount of work on our end, we can make people feel a lot better about their overall situation, because finance is obviously very important to everybody.
It is indeed. I see some people joining. Hello to everyone. Thank you so much. I see Sarah, Perpetua, Rachel. So thank you so much for joining in. There's a wave to Rachel. To give a bit of background, AD, you want to start?
Yeah, absolutely. So we, actually, I started this business about, it was coming up 12 months actually. I was previously a private banker for doctors, dentists and vets. Very different cohort to deal with from a finance perspective. After setting up a broking business and really doing loans for, I guess, a multitude of different clients, it became apparent that nobody was actually servicing the legal community. It became apparent that there were a lot of benefits to lawyers due to their low risk profile that the lenders perceived them. And it also became apparent that the lawyers didn't know anything about it. Most brokers didn't know anything about it. The banks weren't advertising it, and the law societies weren't across it either. So that was a year ago now. Ergo, we went a full rebrand. Legal Home Loans was conceptualised.
As opposed to the Legal Home Loans.
Correct,
Of course, we've had that one before.
That, from time to time. So, Cullen came on board. I poached him from Macquarie Bank. Yep, he didn't want to go at first, but certainly well and fully on board now. And we've been doing this for the last 12 months, and we've really been able to make an impact on all the clients that we've been able to service. I guess just through the expertise and knowledge that we have as to what is available to a lawyer. Doctors in finance, they get it the best. They can really get benefits anywhere they go. However, the lawyers get the same benefits. They're just much harder to find.
Oh, fantastic. So I just want to say a quick thank you to Clarissa Raywood, the Happy Lawyer, for having us on the show, and Sarah Folland, her assistant that coordinated this whole thing. We've gone off the poll for now. We've got some great questions that you all voted on as legal professionals. What did you want to know about your finance? And we're going to cover them. But by all means, please comment during what we're talking about and after in the comments, and we can see them, and we'll try and access as many as we can.
Sounds good.
So going for the first top-rated question that you all wanted to know about as legal professionals, what benefits are there in the market for legal professionals? And I'm going to hand it to Director Andrew Johnson to cover that.
Thank you, Cullen. I appreciate that. Okay, so the biggest one, and the reason, probably the biggest catalyst for Legal Home Loans starting is the ability for lawyers to purchase without lender's mortgage insurance. So, the majority of the population need a 20% deposit to purchase property. Lawyers can purchase with a 10% deposit, so they can borrow up to 90% of property value and not pay lender's mortgage insurance. Really, really amazing benefit for legal professionals. Now, that can also be utilised not just when purchasing property, but also when, if you're looking to, renovate your home, take equity out of your property, similar type things. Being able to utilise that higher percentage value in borrowing, is really important and really, really useful. It's only offered by 3 specific banks, and only in very specific circumstances. We use those banks, very differently depending on the person's individual situation. So that was huge. When we first came onto market, we sort of thought, well, we better educate people about this because we were seeing clients that had gone into into the wrong bank or spoken to the wrong broker, incorrectly paid mortgage insurance, and on $1 million property, that's $20,000.
$20,000.
So we, that was one of the really, more glaringly obvious benefits that we wanted to convey to the market, because typically what we found was the typical busy lawyer would say to their partner, "Who do you bank with?" They say NAB. You go down the lift, go to the
Nothing
bank.
against NAB, but they said NAB.
Yeah, NAB gives you a loan. NAB gives you a $20,000 mortgage insurance policy. You're none the wiser, and it's actually it's much easier than that if you're talking to the right people. So I guess that was the biggest one, the biggest reason that we started the business.
That was May the 4th, by the way.
That was
May the 4th last year. That's
correct.
Apparently Star Wars Day.
So I guess from there we've sort of learned and had many discussions with lots of different banks about what they actually do offer legal professionals. It's very interesting how they don't actually advertise any of these benefits, and they're sort of it's all a bit smoke and mirrors, even when they talk to us about what's available to lawyers. But we're sort of setting some good precedent now with the different lenders. So these are some of the other benefits, which will probably be more quite important to people in this group as entrepreneurs. There are products out there for lawyers where they can borrow with only 1 year's financials.
12 months.
Which is only 12 months of trading, which is very important because if you are self-employed and you've ever gone for a loan, you'll know that most banks and lenders are asking for 2 years trading history. As a lawyer, they're more than happy to actually take a 1 year, 1 year's earnings, as long as they're consistent with your earnings at the big firm that you've left as a senior associate on. Whatever you are, if you're doing similar numbers in your law practice, which most of our clients do, you can actually borrow after just that 1 year, 1 year in trading. For our firm owners, there's some fairly bespoke products by way of unsecured lending for working capital, expansion, marketing, whatever it is. So just a few different ones we've sort of, picked from around the industry. Lenders are happy to use 1 year stabilized earnings and will lend that amount on an unsecured basis. Some lenders will take 60% of fees and lend that on an unsecured basis. There are other products available to lawyers where they'll say $500,000 per eligible partner on an unsecured basis. So, obviously all this is subject to credit criteria, etc. I could put my disclaimer in there, but
T's and C's. We used to that with our legal clients.
Absolutely. But these are very bespoke products that aren't available to a cafe owner or someone who's operating a real estate business or similar. They're sort of specific to professional services, specific to legal. In the barrister side of things, Chambers comes up. It's a very, we're still trying to, explain to lenders fully what a Chambers is and how they can take security over it. But there are some quite interesting Chambers products out there that are more or less unsecured from the bank's point of view. And they'll do up to $500,000 unsecured for Chambers as well. I'm not sure whether we have barristers in this group, but that's obviously quite a bespoke product. On the asset finance side of things, so if you're purchasing your car, you're going down to Mercedes on the weekend to buy a new car, $150,000 pre-approved automatic for eligible partners and firm owners without financial
directors of the business.
Yeah. So that's huge. That's massive. That's without actually providing the information on your company. You get $150,000 per car, which we had to triple check that. That is the policy. Then there's other loans there if you're looking to buy into a firm, and become a partner. There are facilities available. They can be backed by the firm if the firm banks with a certain bank. So there are products there that don't have to impede on your personal, borrowing scenario. So yeah, that's kind of the sphere for the legal professionals in terms of finance. Obviously, this is a very sort of, brief overview of what is available, but it's when you're looking at a lawyer, either PAYG or a firm owner, and obtaining some of these products that we have, it's chalk and cheese in comparison to the to the rest of the population operating different businesses. So.
Indeed. Thanks for covering that. Yeah.
No,
That's
no worries.
fantastic. And we've had some more people join, so welcome. Welcome there, Jen. Welcome, Linda. Welcome, Melissa. And I'm glad I pronounced your name right, Perpetua. So what we're going to do is we're going to move to the second highest one on our list. Should I lease, refinance, or pay cash for my new car? It's quite an interesting question because I have the discussion all the time with clients that have mortgages. You know, Cullen, got a new $30,000 car that I want him to get. I'm just going to release equity on my house at 3% or 3.8%, whatever the rate is on the house. And I'm not going to pay cash. I'm not going to pay the 7% on the car.
Yeah.
And I say, look, you can do that. Of course you can. But you have to remember that a car is a depreciable asset. Okay? As soon as you drive it off the lot, it depreciates in value. Now, a loan on your house, a mortgage, it actually comes from the French word until death. So
Yes.
for 30 years, mortile. But if you take a car and release equity for it,
Yeah.
that's $30,000 that's amortized over 30 years on a depreciable asset that you're going to be replacing in 5. It actually ends up being more expensive to do that at 3.8% over the 30 years. You obviously can pay cash if you have the cash sitting there, but for entrepreneurs and business owners like yourselves, for cash flow purposes, which is the lifeblood of any business, leasing is the way to go in the new paradigm of finance and ownership. It's all about access over ownership now. iTunes, Spotify, any new Netflix, anything like that, it's all about just paying that fee.
No one wants to own anything.
No one wants to own anything. So obviously being in finance, we are big proponents of leasing, but we practice what we preach. We both lease our cars as well. And the reason is because your repayments are fixed per month. You know what they're going to be. The rate is very compelling, especially if you're getting it as a business owner under a chattel mortgage. It's tax deductible. The rate is either late 5s, early 6s, so it's quite compelling for business owners. And even consumer lending, now that they've changed the laws with flex commissions with the dealers, it's much more competitive. It's based on risk rather than the dealer just going, what can you afford? $500, oh, let's increase our commission. That's no longer. So it's very more fair.
And yeah, just on that note, be wary of dealers.
Be wary of dealers.
And their finance. Yeah, anyway, we won't go into that, but be wary of dealers.
So we want to, we've created a one-stop shop. I know a lot of people use that, but we have for getting your finance ordered for your car. Not only can you get your finance pre-approved, and we talked about $150,000 for partners and directors. If you're 12 months ABN and GST registered and your property backed or you have a 20% deposit, you're automatically approved or, pre-approved for $100,000. If you're 2 years ABN and GST registered and you've got a property or a 20% deposit for the car, that goes up to $150,000. So just something to keep in mind as well. And we can also organise the finance, but also the car sourcing. Now, where we talked about be careful with the dealers, if you are allergic to salespeople, allergic to dealing with people like dealers, and you don't have the time as legal professionals, we coordinate the car sourcing. It's a complimentary service. You get a fleet listed price on the car. They'll organise the test drive. They'll organise the delivery. So come and speak to us. We can coordinate that end-to-end process over there for financing the car. So thank you so much for writing in that question. The third question is an offset or savings account more effective for my surplus cash? AJ, I'm going to throw it to you on here.
Yep, absolutely. And I'll answer it quite simply. It's definitely the offset account. The offset accounts, offset account is a really, really great product. You really want to be utilizing that with any loan that you have. And I think there's a lot of misconception in the market as to just how useful the offset account can be. So that just for anyone that doesn't know, the concept of an offset account is any funds that you have in an account that is attached to a loan as an offset, you don't pay interest on in that loan. So if you have $1 million home loan and $100,000 in your offset account, you're only going to pay interest on $900,000. Okay, so that's very simple and straightforward. However, what we advise our clients to do is actually utilize offset accounts for their everyday, to have all their money, all their income deposited in there, all their savings sitting in there, or you can organize sub offset accounts, so you can have a savings account and an everyday account. Interest is a daily calculation, so if you're having your salary of $5,000 deposited in, and then you're going to spend that over the next week, you may as well be getting a benefit from that offset, during those days. Yeah.
Correct.
So we see people, say, they'll select a basic product in lending. A basic product will typically not have an offset account, may have a cheaper rate. It may be an introductory rate without an offset account or a fixed loan. Really what we say is, the offset account is imperative, and as a tool of actually saving interest, it's a great thing that the banks actually offer, so take advantage of it.
Yeah, so the main message is 3.8 saved interest is better than 2.5 that you're going to get in your savings account.
And it's probably more like 0.9.
0.9. It's really quite minuscule at the moment.
Yeah.
So and obviously you can have variable or a fixed portion. It's mainly 100% applied to your variable portion, so something to remember. The next one on our list actually applies to business owners and the barristers we deal with. What's the bank's view on tax arrangements and tax debts?
Yeah.
This is actually quite an interesting one, and one that we see daily.
Yes.
Now, we understand why it would be you'd think it prudent in your mind to go into a tax arrangement with the government. It's the cheapest loan that you're going to get next to your HECS.
Yes.
And we certainly understand it, and our clients see it as a strategy. Unfortunately, being ex-bankers and working with banks day to day, they don't see it like that. They see it as a conduct risk. They see that a loan to the bank is not a good position to be in, because in actual fact, and it is reality, the government can reclaim that money anytime they want. They can go, Mrs. Smith, next week, that $30,000, we want that in full, anytime. So that's why
take half your wages until we get it.
We're going to garnish that until we get it. So long story short, obviously you see it as a good strategy, but just bear in mind that if you have one, it doesn't make lending impossible, it just makes it more difficult, and there's going to be more questions and more due diligence.
Most lenders, if a tax debt is there because we're looking to use it as a cash flow strategy, that's something that banks are going to see as unacceptable.
Yeah.
So as much as it is a cash flow strategy in some places, it's not something that the lenders like. So obviously they come up for different reasons, but if it's simply a case of I keep a rolling tax debt because it helps my cash flow, it's not something that the banks are going to be too fond of.
Yeah, fantastic. We'll keep on coming with those comments, guys. Welcome, Tanya, who just joined. Any more questions? Well, we've got about 4 more from the poll, or 3 more from the poll, but by all means, keep on adding them because we've got a half an hour segment here. This one is actually quite important. It's a great question. Seeing as though we've just moved out of the Royal Commission and things have changed in the credit tightening and whatnot, what metrics do financiers use to calculate my borrowing capacity and borrowing power? This is a good question. I'm going to throw it to you, Andrew, on this one.
Yep, absolutely. Well, there's a few things actually, and we're kind of going to get into the ins and outs of how banks assess at the moment. So there's a couple of things. There's income, expenses, and liabilities. So if we start with income, there's, I guess, the strongest income or most reliable in the eyes of the banks is PAYG. So anyone who's getting a pay slip, whether it be, ideally probation passed, but some lenders don't actually even care about probation. So one pay slip is essentially the strongest type of borrowing that we can, the strongest type of income that the lenders will receive. Behind that, you have things like rent, bonuses, commission, any sort of income that isn't guaranteed. However, it may be contractually written in that you will receive a bonus, contractually written in that you receive commissions based on, work that you build, etc. Those types of incomes, rental income included. Obviously people would say, oh, well, rent's 100% safe. However, they too, people move out and there are vacancies and tenancy and things like that. So those types of incomes, they'll shave to 80%.
They mitigate their risk.
Correct, you then have on income, you then have self-employed applicants. So self-employed applicants, there's lots of different ways to assess their income. And this is where the value, I guess, of having a broker in your corner really becomes apparent. Some banks take 2 years and take average. Some banks take 2 years and take the lower. Some banks take 1 year and will only use net profit and won't take any accounting costs add back, for example, depreciation. Some banks take 1 year financials However, they will add those back. Then they will look at at all the other costs within the business. There is just it's different with every lender. There's about 15 different ways that they assess businesses. So it's really important that you may get declined every day at ANZ and approved at CBA just because of the way that your financials look over the last 2 years. So that's, I guess, really important. Let's speak to the right people. So that's I guess the income side of things. If you look at income, they will derive a figure based on what it is, what their policy dictates the income goes to. We then go to expenses, and obviously there's been a lot of hype in the media recently about expenses, and there's a lot of people saying, I got declined because I use Uber Eats, or those type of things. There's a little bit of that's a little bit of scaremongering.
There's a bit of fearmongering in the market
and whatnot. So look, the reality is nowadays expenses are viewed extremely. They're really viewed very intently. For example, a couple of years ago, expenses were one line. How much do you spend, Mr. Customer? $2,000. Okay,
that's fine.
There's now 13 different categories for expenses, and we're expected to go through them in detail with our customers. We're also expected to verify those against cash, against bank statements. So yes, if you do use Uber Eats every day, we would see that, and that would form a picture of your lifestyle. It's very unlikely that you would get declined for something like that.
No.
Realistically, all the lenders are looking to do is actually paint an adequate picture of your lifestyle, so that you're not going from eating caviar one day to Vegemite sandwiches the next, because that's really seen to be getting a loan that now you can't afford those things. You've now put yourself into hardship as to what you were previously doing.
They're very risk averse. They don't want to put you into financial duress, so they just want to.
So they look at your lifestyle and will derive from that. In most cases, what will be taken as expenses is what's called HEN, which is the housing expenditure model. How that works is they will look at a client and say, right, you're single and you live in this postcode, or you are a family of 4 and you live in this postcode, and they will basically say, based on our data, you are likely to spend this figure per month.
Yep.
And that's typically where most expenses will lie, because the HEN is very conservative. A lot of people will be around that, and rarely we see people that are spending that are very extravagant with their spending. And people can be. They've got enough money, but most of the time people sit around that HEN model. And then from a liabilities perspective, I don't want to bore you with the intricacies of bank assessment, but
I think the main thing is credit cards and personal
correct.
loans.
Any home loan will be assessed at 7.25%, as opposed to the rate that you're actually getting, and credit cards are looked at limit, not at the balance outstanding.
Banks actually don't care about that.
They don't care about that. They look at the limit and they charge 4.25% of that to your monthly expenditure.
They want to look at your risk. Your propensity to spend. So all those factors go into your borrowing power.
Yes.
And your borrowing capacity. So that's quite important. One interesting question, I think this one came from Nikki Drummond, and we met Nikki at the Beyond Billables conference last year, which was fantastic. Michael and Marcek from the team there. Now, the question is, other than Westpac, is anyone doing the insurance fees, the insurance premiums, and finance practice management? The question is yes, there are. Breaking it down in terms of your practice management, one of the lenders that does it very well, I'm not being biased here as I used to work there, was Macquarie Bank. They have their own equipment finance division, software finance division that can help with that section. That's more of a case-by-case scenario, and it's based on the strength of the applicant. It's not a one-size-fits-all, so it really bases on your profile. So if you've got any questions, feel free to reach out to me, or we'll introduce you to the right people. And the same again, in terms of financing your premiums, Westpac does it, and also again, Macquarie does it. They have their premium funding arm. And we don't do it directly, but as an added value, we introduce you the right people that can talk about that with you and go through the scenario. So yes, other than Westpac Queensland, there are other people that can do it. Based on your scenario, come and speak to us and we'll introduce you to the right people to do that. This is a very good one. This is our last one on the poll, so make sure you get your questions in, guys, in the comments. We want to know more of what you want to cover. What is lender's mortgage insurance, LMI, and how do I avoid it? Andrew? My goodness.
I sound like an accountant. I look like one.
No, you're getting all the good ones, my friend. You're getting all the good ones.
Yeah, okay. Lender's mortgage insurance is it's a premium, insurance premium that the banks enforce the borrower pay for loans that are written over 80% of property value. And what it does is it insures the bank against any loss that they may incur as a base. Sorry, just reading those comments there. Sorry, Sarah.
Sorry, Sarah, for the background noise.
Yeah.
We'll speak a bit closer in there.
Yeah.
We'll talk a bit down.
Yeah.
You get a bit of reverberation.
They essentially insure against any loss that they may incur if they have to foreclose on the asset. So if they have a loan of $900,000 against the asset and they can only sell it at $850 in a foreclosure, that $50,000, that's what's insured by the mortgage insurer. So it doesn't help you. It certainly doesn't. It doesn't help anyone other than the bank, and it's a big, hefty premium. It's a one-off, non-refundable premium that you end up paying for.
Yeah, basically you're paying for it one-off, and
Yeah.
you're mitigating the back risks. No one else.
And if you're a lawyer, you should be avoiding it.
You definitely want to leverage your elite risk profile in the eyes of the banks and try and avoid it. Hello to everyone who's joined: Tanya, Emma, Kim, Cynthia, Cassandra. Thank you.
Hi guys.
And Sarah. Apologies for the background noise.
Yes.
We're quite loud here. Nonetheless, so yeah, I guess those are the main tenets that we covered from the poll. Opening up to the floor, is there anything specific that you're wanting to know more about in terms of your finance, lending, any scenarios where you want to run past? Well, put them in the comments. I guess at the moment, just so you know, in terms of if you've got a property and you're thinking of refinancing, a lot of the banks now, especially the major lenders, are offering what's called the rebate or the cashback. It's $2,000 for every property loan above $250,000 that they give you on settlement to help mitigate your break costs per property. So if you've got 3 properties, they've all got loans attached to them over $250,000. The bank that we move you to will give you $2,000 on cashback, which is quite important.
Yeah, some really good rates coming out as well. I guess and really good rates. Thanks, Sarah. I guess in terms of rates, what's quite interesting is we've got a lot of banks increasing rates on their existing customers. Yes. And lowering rates for new customers, which is great. Typical bank model, reward no loyalty.
And just keep on increasing the rate of the incumbent valued clients.
Correct. So, this is a strategy that many of the banks use, and it's because people find, I guess, refinancing their home or investment loan to be a headache, and to be fair, in some cases it can be. However, on principle, it's really not right. And what we spend a lot of our time doing is actually renegotiating with lenders on behalf of our existing clients. Saying, hey, can you please lower that rate on our client? And a lot of the time they will. So a lot of the time they actually do have the power to do that as well. So quite interesting environment we find ourselves.
Lending is always interesting, absolutely. But we've seen from the cookie cutter scenarios to the very complex. We deal with it day to day. I guess the main value add for ourselves, we love doing things like this, elevation through education. But we understand the way you're remunerated, if you're a firm owner, the way your finance is structured there. If you're a partner, you're a barrister, whatnot. I think our long-term value is the expertise and the different banks that offer different products based on your situation. What we usually find is clients getting very frustrated going from either a bank or another broker who doesn't really understand the way a legal professionals works, or the way all it is a matter of understanding.
And on that well-being piece, having someone that that you can just email and say, hey, can you fix this, goes a long way. And we get that all the time.
We get that all the time. We usually do it
Andrew, this is happening. Fix it.
And most of our meetings are done in Sydney, 15 minutes over a coffee, but some of them times they only give us 5 minutes and say, here you go, all the best, and then we sort it. So,
it's one of those functions you can outsource, I guess is the main thing. Outsource, not think about, and everyone saw the Royal Commission and how Commissioner Haynes, for some reason, wants customers to pay for brokers, which is ridiculous. But at this point in time, it's a no-fee model, so we're paid by the banks, and that doesn't come out of any of your pockets. So take advantage of that expertise whilst it is, for all intents and purposes, free to you.
Thank you so much. Or if there's not any other questions,
ask some questions, guys.
Yeah, please feel free. Look, it says half an hour, but we're more than happy to go over time. Sorry, Sarah. Sorry, Clarissa. Like, we're taking up the bandwidth on the group there. Any final parting questions that anyone wants to know about?
Nearing cricket.
That's all right.
All right.
Well, one thing I do get asked a lot, and it goes back to our offset question, is can I just do fixed? Can I just do variable? Can I have a split facility?
Yep.
So a split facility for your home loan is one where you have some fixed and some variable.
Yes.
Now, we can't advise whether the rates are going to go up or down. It's like, it's sort of out of our hands. But the thing is, you can do both. So what we usually say is, whatever you think your savings are going to be, if we fix your loan for 2 years, if you think your savings are going to be $50,000 in the next 2 years, we'll usually do the variable portion on that, just so you're getting the variable and you're also getting the a cracking fixed rate. Thank you for joining, Brendan. I wonder if you've got a question for us, my good man. All right.
We'll leave it there.
If there's nothing else, guys, thank you so much to Clarissa Raywood and the team at The Happy Lawyer, and obviously Sarah for inviting us on the show. It's been great.
Thanks.
Yeah, you can get us. We're very prolific on LinkedIn and Facebook. Feel free to reach out to us, DM us, email us, and we're more than happy to look after you.
Thanks, guys.
All the best. Take care.
Cheers.